Look at the heavyweights of the Indian internet today, and you'll find InfoEdge. They command a 90,000 crore rupee market cap. They were the very first internet company to list on Indian stock exchanges, and they operate as the invisible financial engine behind household names like Zomato. But to understand how they built that empire, we have to rewind to 1995. At the time, the Indian economy was intensely analog, running mostly on physical paper and cash in crowded street markets. Working out of a small servant quarter in Delhi, founder Sanjeev Bikhchandani was trying to get a digital business off the ground using incredibly primitive technology, including a rented American server that cost him $25 a month. When he officially launched Naukri.com in 1997, the platform was entirely dependent on physical media. His team built their initial database of 1,000 jobs by manually copying the print classifieds from 29 different newspapers. This scrappy operation managed to navigate the 2000.com crash, go public in 2006, and remain profitable through the 2008 global financial crisis. How did a manually scraped web page outlast thousands of well-funded competitors to dominate a national digital economy? InfoEdge succeeded by perfecting a dual-engine business model that prioritized operational scale and capital efficiency over technical flash. InfoEdge identified that people faced immense friction when making high-stakes life decisions, things like finding a career, buying a home, or choosing a college. To bring those offline decisions online, they built a two-sided marketplace. Keeping platforms entirely free for job seekers and students generated massive user volume. On the side, recruiters and real estate developers paid for access to that concentrated base, providing steady revenue. By utilizing this corporate subsidized model, Naukri.com eventually captured roughly 80% of the online recruitment market in India. They replicated this blueprint, launching 99 Acres for real estate, Jeevansathi for matrimony, and Shiksha for education. This was their first engine, a self-sustaining cash machine that converted routine human life decisions into predictable corporate revenue. Because their classifieds businesses were so efficient, the company began generating far more cash flow than its core operations required. This structural map reveals how they utilized that surplus. They used their profits to establish InfoEdge Ventures, a dedicated arm focused on startup investing. This cash reserve allowed them to back high-risk, early-stage Indian internet companies years before traditional venture capital arrived in the region. Their portfolio includes a first-mover bet on a food delivery startup called Zomato, which later became Eternal. This expanded into significant stakes in companies like PolicyBazaar's parent PB Fintech and the logistics platform Shiprocket. By deploying their capital this way, InfoEdge became a kingmaker, using the profits from India's first internet generation to bankroll the next. Today, many of the highly publicized competitors from the early internet era have disappeared, while InfoEdge continues to expand its reach. Their 3-decade survival relied on capturing inescapable necessities like hiring and housing, rather than chasing speculative digital trends. By digitizing the legacy systems of old newspaper classifieds, InfoEdge provided much of the early capital and scaffolding for India's digital economy. This underlying architecture created a stable environment for the wider Indian startup ecosystem to find its footing. The most enduring influence in the tech world belongs to the quiet companies that facilitate a market's most essential life decisions and fund the ventures that follow. Look at this line chart showing the sudden, devastating reality of the 2001 dot-com crash, a sharp downward plunge erasing billions overnight. When a macroeconomic shock like this hits, the tech industry defaults to a standard survival playbook. You immediately cut your budget, freeze all operations, and lay off as many staff as possible. InfoEdge did the exact opposite. Right in the middle of this market meltdown, they hired 80 new salespeople. The logic was highly counterintuitive. When panicking competitors fire sales teams, they abandon clients, creating a massive market vacuum. By staying aggressive, InfoEdge absorbed that empty space, surviving the crash, while their wealthier rival, Jobs Ahead, was sold off. This stubborn refusal to follow conventional tech wisdom established a strategy of opposites, a highly calculated approach that would eventually build a 90,000 crore rupee empire. 7 years later, the global ecosystem faced a second massive shock. The 2008 financial crisis fractured the economy all over again. Major recruitment rivals like Monster and Times Jobs fell right back into the exact same trap, gutting their sales forces to preserve cash. InfoEdge ran their playbook a second time. They held the line and refused to execute a single layoff. This bar chart visualizes the mathematical proof behind that decision. Over those 3 crisis years, their online recruitment traffic share jumped straight from 43% to 63%. They stress-tested this approach one more time during the 2020 pandemic. The executive team ran the numbers to secure a 3-year financial runway, strictly to guarantee 0 layoffs. For InfoEdge, global economic crashes are not unpredictable disasters. They are highly predictable mechanisms used to aggressively capture market share. By 2010, the company was publicly traded. Their core recruitment operations were highly profitable, leaving them with a sudden, massive surplus of cash sitting in the bank. The expected corporate move here is simple: hoard the cash reserves or start buying up direct competitors to form a monopoly. Instead, they pivoted to become an early-stage venture investor. They wrote a 4.7 crore rupee check to an unproven startup that had absolutely nothing to do with online recruitment. The target was a small company called Zomato. At the time, they had no food delivery model at all. They were literally wandering around local, scrappy eateries like this one, taking basic digital photographs of physical restaurant menus. Founder Sanjeev Bikhchandani completely ignored the lack of a proven business model. He bet entirely on the founder's drive and the theoretical size of the restaurant category they were trying to map. Writing a check for a menu photographing experiment proves that InfoEdge evaluates value differently than the standard Silicon Valley model of hype and quick exits. When Zomato went public in 2021, that original investment returned roughly 1,050 times its value. Contrast that venture success with the scale of their core operations today. That primary engine generates nearly 2,850 crore rupees in annual revenue. The modern company operates as a dual system. A dominant core tech business quietly funds a massive, compounding galaxy of startup investments in the background. Sitting on a market cap of over 90,000 crore rupees, they prove that optimizing for 3 decades of survival heavily outperforms the typical 3-year startup exit. The next existential challenge is integrating AI across their dominant platforms like Naukri, 99 Acres, and Jeevansathi. They are avoiding the trap of chasing flashy, standalone AI categories. Instead, they are quietly deploying the technology to process data and draw deeply personalized, smart connections within their existing user bases. Simultaneously, their venture arm is relentlessly hunting for the next Zomato, guided by the exact same founder-first instincts established in 2010. InfoEdge built a massive internet business without relying on Silicon Valley hype. By refusing to follow the herd and focusing entirely on solving immediate consumer problems, they proved that the ultimate disruption is simply playing the long game. InfoEdge functions as singular market infrastructure, utilizing predictable cash flow from established utilities to fund a wide, volatile perimeter of tech startups. This structural identity is best defined as multi-vertical infrastructure. Individual consumer applications for recruitment, real estate, and education function as distinct access points for the exact same underlying digital architecture. The system captures and monetizes massive data sets by channeling them through centralized digital marketplaces. To determine the actual value of this conglomerate, we must deconstruct the mechanical physics of its legacy moats and weigh them against incoming technological disruption. Analyzing such a business requires looking past brand marketing to focus exclusively on the structural flow of data and capital. We begin by examining the foundational atom of the entire operation, the single digital matching transaction. Analog discovery is characterized by extreme friction and high costs. In a physical market, the single recruiter struggling to find one qualified applicant in a localized geography faces a low mathematical probability of success. A centralized digital platform eliminates this physical friction by acting as an intermediary with total visibility over the available labor supply. This facilitation represents a two-sided network effect, allowing instantaneous connections regardless of physical distance. The platform extracts a specific fee by resolving that structural inefficiency and capturing a portion of the resulting economic value. The marketplace derives its primary utility from the behavioral gravity it exerts, concentrating both buyers and sellers into a single taxable location. This structural efficiency is amplified by massive macroeconomic tailwinds. Millions of new graduates enter the Indian workforce annually, creating a demographic reality defined by a vast, recurring influx of human capital. This surge in labor supply requires a centralized digital layer to pair high volumes of applicants with corporate demand. A second driver is the large-scale urbanization occurring across the subcontinent. Rising urban density creates a chaotic informational environment for real estate, necessitating the use of a digital clearinghouse. These physical realities map directly into digital architecture. Massive inputs of demographic and urbanization data flow into the system through tight, constrained bottlenecks, represented by specific digital platforms. The output emerging from these bottlenecks is processed into highly structured, monetizable data profiles. These platforms function as mechanical capture funnels, positioned to intercept the most inevitable structural shifts in the Indian economy. If the software is relatively simple to replicate, why do well-funded global competitors fail to disrupt these funnels? The primary defense is algorithmic lock-in. As the volume of job seekers on the platform grows, the system becomes more useful to recruiters. This mathematical increase in utility pulls more recruiters into the system to access the concentrated labor supply. The influx of recruiters then acts as a magnet for more job seekers, completing a self-reinforcing flywheel. Competitors cannot simply launch a better interface. They are forced to simultaneously subsidize and acquire both sides of the market from zero, a task that is often financially prohibitive. This lock-in results in predictable revenue, pricing power, and a lack of debt. Once a digital marketplace reaches critical mass, it functions as an unavoidable toll bridge on its respective sector of the economy. A highly profitable digital toll bridge eventually faces a capital allocation dilemma. Legacy funnels provide steady growth, but early-stage tech ecosystems offer the potential for explosive, volatile expansion. The company manages this by capturing asymmetric upside. By siphoning off the cash exhaust from its monopolies, the company places dozens of high-risk bets on emerging internet models. A single outlier success can yield returns that outpace the core business. While many of these investments will return zero, the strategy protects the balance sheet while allowing participation in rapid growth. This creates a hybrid operator-investor model that analysts must account for. The conglomerate uses the absolute certainty of its legacy funnels to finance the extreme uncertainty of the future digital economy. This structural invincibility is now challenged by a credible systemic vulnerability. The tollbridge model relies on the platform owning the search logic, requiring users to manually input keywords and navigate filters. This creates a risk of systemic disintermediation. An AI layer can potentially force its way between the user and the platform. This layer bypasses the central hub by drawing a direct, faster connection between applicant and employer, draining value from the core platform. If large language models can autonomously scrape data and pair a candidate's resume to a job description, manual search filters lose their utility. Years of accumulated behavioral lock-in offer minimal protection if autonomous large language model pairing replaces the manual keyword search as the primary method of digital discovery. We must now move from evaluating operational architecture to evaluating the business as an equity in the institutional market. This requires a look at equity pricing mechanics. A structurally flawless enterprise is only one part of the equation. The second is determining what the market is demanding you pay for it. The market often bakes future growth projections into the current share price, resulting in a significant premium that reduces the margin of safety. An investor must weigh the moats, the macro funnels, and the venture upside against the cost of entry. When aggressive weights for premium valuation and AI risk are added, the scale struggles to find equilibrium. Every investor must personally weigh these structural certainties against technological uncertainty. A company with an invincible architecture is only as attractive as the price paid for its future cash flows.